volume, because you can use that tick volume to create bars as opposed to time. So either one. Traditional velocity indicators include simple oscillators, which are basically the difference between two moving averages, the stochastic, the RSI. And then you've got second derivative indicators. And second derivative indicator basically just means acceleration. It's the rate of change of price relative to the square of time or square of volume. And a good example of that would be the MACD, which is in essence an oscillator of an oscillator. And we're going to take a look at the math. And I'm going to keep my eye kind of half on the chat line here to see if anybody has any questions as we go along. Momentum indicator, how are momentum indicators used in trading? Well, the most common way and least helpful way, I shouldn't say least helpful, but just kind of a way that maybe slightly improves on things like moving averages, is to use is to substitute them for trending indicators. So instead of using a moving average crossover, you might use a stochastic crossover. And that's a very simplistic way to use momentum indicators. The second way is to use them to identify market turns. So the next question then becomes, what's a market turn? If you're going to use a momentum indicator to identify a market turn, then how are you going to define what a market turn is? So the way that we define what a market turn is basically this. If the market turns enough that you wish you would have gotten out sooner, it's a market turn. That's a kind of a qualitative definition. And if you want to have quantitative definition, it's the turn against the prevailing trend of significant magnitude. And we define significant magnitude. The sound is in and out. Is the sound still in and out? Because I'm sitting here right in front of the microphone. I hope everybody can still hear me. Okay. Okay. So let me repeat that. A turn against the prevailing trend of significant magnitude, and the way that we measure significant magnitude is by using standard deviations of range. And we're going to talk about that. But the bottom line is, for those of you who don't want to get bogged down in the math, is that we use statistics to figure out what's significant in terms of a market turn. Okay, so now we're going to go through the traditional indicators, the stochastic. And basically the stochastic is, the idea behind the stochastic is that closes should be in the direction of the trend. So what a stochastic does is it looks at the range of prices over a certain period. So for example, if we're using an 8-period stochastic, it would look at the lowest low over the 8 bars and the highest high over the 8 bars, and that would be a range. And then it would look at where the close is falling in that range. And if you look at the two little charts to the right there, you can see that in the upper picture illustration, the market's going up, and the closes are higher and higher relative to the bar, and then, of course, it would be relative to the range. On the bottom chart, the closes are, even though the market's climbing, the closes are towards the bottom of the bar and falling. So it kind of looks at that type of phenomenon, and then it smooths it, and then smooths it again, and so that's how the math works. And the only difference between the percent K and the percent D is the percent K, let's call it the raw percent K, is the reading of where that close is relative to the high-low range, normalized from 0 to 100. And the percent D is usually just a 3-period moving average of the percent K. So it's just a smooth percent K. The slow D, the slow K and the slow D is as follows. The slow K is equal to the percent D, and the slow D is a triple moving average of the slow D. So it's just a smooth average of that measure of where the market is relative to where the close is relative to a high-low range. And this is just a picture of what it looks like. You can always tell which is the K and which is the D by which one is smoother. The smoother is always the D. Okay? All right. Here's the RSI. And the RSI is virtually designed on the same principle, but the math is a little different. The ratio of the up closes and the ratio to the down closes. The ratio of the up closes to the down closes. And of course, if you're in an up market, then theoretically you should have more up closes than down closes. Okay? But if you have a rising market with more down closes, then the momentum is beginning to fall. Now the MACD is, in a sense, somebody asked me what the parameters are that I suggest for stochastic, and that's kind of a hairy question because there's a couple of different ways to answer it. Basically, you always want to trade with a couple of different techniques. And one comment by way of introduction, I like Fibonacci numbers. So numbers like 5, 8, 13, 21, 34, 55. And so what I like to do is, if I'm going to use two indicators, I like to use one kind of short and one kind of fast. I mean, one kind of short and one kind of long. So if you're using a short-term RSI, like 13, maybe you want to use a longer-term slow stochastic like 34. And I just say play around with it a little bit. I like, when I was using the stochastic, which many years ago, I used to like the 34. Okay, moving on. The MACD, by the way, I usually just use whatever the defaults are. And so, in any case, what the MACD does is it just is, everybody knows, I would hope, who's listening to this, what an exponential moving average is. And so what the MACD does is it takes the difference, I'll say this slowly, takes the difference between two moving averages, and you can see that in this first formula here, oscillator MACD equals exponential moving average 1 minus exponential moving average 2. And then whatever this value is MACD, that's the original histogram, minus its own average. Okay, so that's what the MACD is. Now we're going to talk a little bit about the math behind my indicators, and you can see that basically the stochastic and RSI look at where the close is, where the closes are. The stochastic looks where the closes are relative to a high-low range. The RSI looks at the up closes versus down closes, and the MACD essentially looks at how fast moving averages are converging or diverging from each other. Very, very simplistic mathematics. So we want to step back from that and point out that all of these indicators, as was suggested by the question, what parameters do I suggest for the stochastic, that you have to pick a parameter, that there's one number you're going to use. So the traditional indicators, by definition, are tied to fixed parameters. So it's a good thing to get an indicator that adapts automatically to cycle length. Also, if you look at up closes versus down closes, or a range, just think about it. If you have an increase in volatility, the range is going to increase. And if you have an increase in volatility, the degree to which the market closes up or down, the value will increase because of increases in volatility. So it's nice to have an indicator that adapts automatically to cycle length depending on market conditions, and adapts automatically to volatility. And so that's what our indicators attempt to do. And they use this in the principle of serial dependency. And this is kind of an idealized picture, but if you look at the right-hand side here, there's a bell curve. Now, it's true that markets don't markets are more log normal than normal, but just for the simplicity of the example, if prices are purely random, and I should say that volatility, the logarithmic rate of change, is more or less normally distributed. So you can use this for logarithmic rate of change. Okay. So if the market is changing, how do you know whether or not the change is statistically significant or random? So if you look at a bell curve, the more the data is closer to the mean, the more random it is. The further the data is from the mean, the less random it is. So, for example, if you have a piece of data that's at 1.96 standard deviations above the mean, then there's only a 2.5% chance that it's random. So to look at whether or not something is random, you might want to look at where it falls on a bell curve. Okay, so that said, this is how the indicators are calculated. Volatility, for those of you who are not familiar, volatility is the standard deviation of the logarithm today of the price today divided by the price yesterday. So the peak oscillator has two measures behind it. One I call KSDI up, the other KSDI down. That stands for Kase Serial Dependency Index. And what that means is it measures the degree to which something is not random, or, to put it positively, the degree to which something is serially dependent, that is, part of a time series. So, I'm going to just answer this gentleman here. Okay, so the way that it works is it's looking at the logarithm of the high today versus the low n days ago. So if you think about, remember the stochastic, it was looking at a range. This is similar, but instead of looking at the highest high or the lowest low, it's looking at what the high is now versus what the low was back n days ago, divided by the volatility over n days. And that'll give you, the volatility is a standard deviation measurement. Just looking up here, volatility equals standard deviation, right? So it's looking at how many standard deviations relative to volatility the market has moved up. And then the KSDI down looks at the logarithm of the low today divided by the high n days ago divided by the volatility. So it's asking how many standard deviations, that is, how many times volatility did the market move down. And what n is, it just flashed away from me for a second. Okay, I'm not sure what's happening there. What n is not a fixed value. What the computer actually does, what the indicator actually does, is it goes through a loop from, let's say, n equals 3 to 65, and it chooses whichever reading is the highest. So it automatically optimizes the indicator for whatever cycle length is the most trendy or most serially dependent. So the Kase PeakOscillator is basically a simple oscillator of those two numbers. It's KSDI up minus the KSDI down, and then the KaseCD is the first derivative of that. Or if you ln is just it's typed where it's just logarithm. Or So that's just written a little weird. KaseCD is the peak oscillator minus its own average. And so it's pretty simple. It's just the first derivative of that. Yeah, the logarithm in the subscript is correct. It's this. Inside it's h sub 0 divided by 8L sub n. That's correct. That's the high today divided by the low n days ago. Okay? So it's the logarithm of the high today divided by the low n days ago, or the logarithm of the low today divided by the high n days ago. I'm going to go ahead and move forward. If anybody has any questions about the math, we can revisit it, or you can always buy my book, or read some of the articles that I've written. Okay? All right, there we go. Yeah, that's, just to explain, for those of you who are not familiar with programming language, it just means Kase PeakOscillator minus the average over the of the Kase PeakOscillator over n days. So if n was 3, it would be Kase PeakOscillator minus the average of the Kase PeakOscillator over 3-day average. That's what the n is there. Okay? So that's what that one is. Okay? And, okay. I'm going to move on. That lower equation, I can't really see it, but it should be L0 divided by Hn. If it's wrong, it's just because my eyesight's not good enough to have caught it. Okay, it's H0 divided by L0 divided by Hn. Okay. I'm going to turn the, Dean's going to go through the, I guess I'm going to do this one, Dean, and I'm going to turn it over to you in a little bit. Anyway, this is what a Kase PeakOscillator looks like. Without getting into detail right now, it just looks like a simple oscillator histogram, not that much different than other histograms you've seen. The big difference, aside from being more reliable, is that these are overbought and oversold lines, and we're going to tell you a little bit, we're going to get into more how these work as we go forward with the presentation. And that's just what the KaseCD looks like. These are divergence lines that are drawn. KaseCD looks an awful lot like the MACD, but has some performance differences, and we're going to talk about that. This is basically just to show you what it looks like on the screen. Next, we're going to talk about what is momentum divergence, and this is really key. What is momentum divergence? In an uptrend, like this, momentum divergence is defined as an equal or higher high in price and an equal or lower low in momentum. In a downtrend, a lower low in price or a higher or equal low in momentum. And there are some fine points. This might seem like a very simple definition, but there are some fine points to its application. And Dean's going to go ahead and get into the fine points now.
Okay, good afternoon, everybody. I'm going to go through a couple of comparisons of divergence, and we're going to look at actually 3 different comparisons. We're going to look at correct divergence, rising highs in price with falling momentum, or falling price with rising momentum. We're also going to look at correct comparisons but non-divergent situations, and then we're going to look at incorrect divergences or incorrect comparisons. First, starting with the incorrect comparisons, designated by the dashed red line in the slides here. We can see in this first example, and let me grab a little pointer here, we can see in this first example we have a low in price and then a lower low in price, but momentum is going the wrong way. We have a new low in price rather than a higher low in momentum. The other thing here, the reason this is an incorrect comparison is because we have a swing high between the 2 swing low peaks. The same thing can be said here with this red dotted or red dashed line where momentum is falling or excuse me, yes, momentum is falling, while price is also falling. So that's an incorrect comparison. Now here we have new highs in price, but we have higher highs in momentum. So the comparison's correct, but it's non-divergent. For it to be divergent, we would have to have a higher high in price with a lower high in momentum. The last one was incorrect because momentum was rising rather than falling. So we had a rise in price with rise in momentum. Momentum would have needed to have been falling, like we see here on the right, where we have a rise in price.
Hey, Dean, I'm just going to interrupt you for a second. On this one, it's wrong because prices are falling. Did you say? I wasn't sure if you said that.
I can't see which one you're talking about, but
the second incorrect one you talked about. That one.
Yes, prices are falling.
But I don't think it was clear, so I'm interrupting. Sorry about that, everybody. I just wanted it to be clear, everybody. It's wrong because prices are falling, and you don't compare falling highs. You just compare rising highs. Okay, I'm getting off now.
Okay, so thank you, Cynthia, for clarifying that. In this case, the last moment or divergence here on the screen, we have falling prices, so we have falling lows with even momentum. Momentum has made a double bottom, and so that is a valid divergence and indicates that the market could be turning to the upside. So these are all valid and invalid comparisons. We're going to go through another slide of these here. This one on the E-mini S&P 500. Very popular thing to trade. Here in this case, we have rising price, rising highs, with falling momentum back over a long period of time. But then even in the short period of time here with this, we've still made higher highs with a double top in momentum here, so to speak, indicating that the market could have turned to the downside, which that was a good indication. Same thing here, where we have the solid black line with falling lows and rising momentum, another indication of divergence and the turn to the upside. Now the reason that this red dashed line, the large red dashed line, is incorrect is because we're looking at falling lows. We're looking at falling lows here with falling momentum. We also have falling lows here with a high peak in between on the short red dashed line with falling momentum. So again, it's an incorrect comparison. These comparisons on the right, the black dashed lines, are correct comparisons because we're looking at higher highs, but it's non-divergent because the market has made higher momentum highs. Same thing here with lower lows, but lower lows and momentum as well. And as Ms. Case is pointing out here, with this short term, with this short one and the long one, we had the highs in between the two peak lows, or two valleys.
Let me just take the mic for just a second. Anyone fading the momentum divergence in the long black line? Well, I mean, the thing is that I would say two things about that. That just points out some of the limitations of using momentum. This looks like the RSI to me. And the second thing is that if this was a daily, then theoretically you could have played each one of these downturns for a short. So I would just say that. But I'm not trying to sell anybody on the RSI. I just want to show you what the normal way of having it work is. And if you're getting too many little bounces like that, you might want to use a longer periodicity. Thank you, Dean.
All right, thank you again, Cynthia. So we're going to go ahead and move to the next slide here, where we're going to talk about some of the divergence, fine points about divergence, and we're going to look at completed and divergence setups. A divergence setup, in this case on the chart on the left, shows rising price with falling momentum, but there's no way to tell whether or not that move higher has stopped. And that's because it has not peaked. The price peak there isn't a peak in price, nor is there a peak in momentum, showing that there's a shift to the downside and that the turn could be coming. So whenever looking at divergence, you want to wait for one bar after the peak to complete or to close to complete the divergence. So in the case on the bottom right, we show the same chart, Google in this case, with rising price, falling momentum, and once the bar after the peak in price and the peak in momentum forms, then you can see that there's a divergence, a completed divergence. Now, one thing to point out here, which is going to tie into the next slide, is that if we look at the peaks in price and the peaks in momentum, they're happening on the same bars. This is not always the case. So we go by a tolerance factor. A tolerance factor is you're looking at comparing price peaks with momentum peaks. So in this case, you had the momentum peak form one bar later than the price peak. Here's the price peak. Here's the momentum peak. In the price peak on the right, the momentum peak formed a little bit early. Generally speaking, in the studies that we have...
I'm going to interrupt you again. People are sending questions and comments back and forth as if divergence was an entry signal. I want to make it clear, I know we haven't discussed it yet, but we at Case never use divergence as an entry signal. We use divergence as a signal to pull in stops and to exit a portion of a trade. Okay, so the weaknesses that you're pointing out to divergence, I would just point out, are the same weaknesses that underlie our decision not to use divergence as an entry. Divergence, though, is excellent as an exit, especially if you put stops below the market, tight below the market, and then if you don't hit them, you don't get out of the market. So I'm just kind of responding to the comments back and forth. Divergence is excellent for exiting the market, but it's not reliable enough to get in. And so in any case, that's what we use it for. Dean, back to you.
Okay, so looking at tolerance, because most peaks don't line up, peaks in price and peaks in momentum don't necessarily always line up with one another. In the studies that Case has performed, we allow a 2 to 3 bar tolerance, meaning that generally the default is 2, but we'll allow as high as 3, meaning that the peak in price, as long as the peak in price and the peak in momentum are within 2 bars of one another, then we'll count it as a valid divergence. As far as time frame, as far as time frame, even up to a daily chart, the defaults that we used in our program or in our studies were on a daily, but we'll do the same tolerance for all time frames as Ms. Case just pointed out. Even if you're trading on a 1-minute chart, we'll still use a 2 to 3 bar tolerance. Overbought and oversold signals. Ms. Case had hinted at overbought and oversold signals. Before we look at the Case indicators and overbought and oversold signals, what we call PeakOut signals, we're first going to look at overbought and oversold on the RSI and the stochastic. Basically, on the RSI and the stochastic, there are levels such as 90 or 10, basically straight lines that are drawn on the indicators that show overbought or oversold conditions. So whenever momentum, for instance on the stochastic, is above the 90 line, generally speaking, traders would consider it to be overbought. Or on the stochastic, if it's above the 80, above on the RSI, if it's above 80, it would be overbought. On the downside for oversold, you're looking at 10 or 20. So in this chart, what we're seeing is the market was in an upward trend On both the stochastic and the RSI, it moved above the 90 or 80 line, went into an overbought condition, but it remained overbought for a long period of time. We can see it remain overbought for days, weeks, sometimes even months. So overbought and oversold signals are not necessarily a great signal for exits, but they do give some sort of a warning. In this case, we're looking at the euro-US dollar, which triggers overbought and oversold signals. The case indicators, the difference here, whenever we look at the case indicators, we'll see that there is an adjusting overbought or oversold threshold, where once the momentum indicator goes above one of those thresholds, we have different conditions. Now, the difference with the case indicator is that rather than triggering overbought or oversold signals once the overbought oversold threshold is overcome, what we call the PeakOut threshold, we wait for a peak in price and a peak in momentum that line up within that same 2 to 3 bar tolerance. Once that occurs, you get PeakOut global or PeakOut local signals. Now, as we can see in this chart, this is the same chart that we looked at earlier. We do show some premature indications of PeakOut globals or PeakOut locals. But again, as Ms. Case pointed out earlier, we're looking at this as an exit signal, or really as a warning, rather than an entry signal. This is showing us that the market could be peaking out and that it could be at a point where it's going to turn, but rather than exiting, we may pull in stops. That way, if the market goes on to make new highs, it will allow us to run with the trade rather than exiting prematurely or entering prematurely for that. So in this case, we can see that there was some fine points where there was exit signals defined as PeakOut globals or PeakOut locals. On this chart here, this Microsoft, we see the stochastic on the bottom, where it had gone into an overbought or oversold condition, remained there for a long period of time. The case indicators went into that condition much later when the market was actually going to peak, and we can see the PeakOut globals, also KaseCD peaks on the KaseCD indicator that indicated the change in direction. So again, we could have pulled stop levels in and exited those trades appropriately. Some comparison charts here. We wanted to show some of the differences.
Let me just pick up on these just to get a little back and forth. I just want to say, guys, I know that some of you feel like it's academic, but what we've been trying to just show you is that because of the math behind the peak oscillator and the KaseCD, you get much more discrete overbought and oversold signals. That's the point of the previous slides. The point of this slide is to show you that somebody pointed out earlier the false signals, that you can get a lot of divergent signals and they don't mean anything. Well, this is the opposite, where you get a market turn and the MACD is non-divergent. It just kind of meanders down at the bottom of the chart. And if you look at the KaseCD, you get a really nice clean divergence. And here is the same kind of thing, basically. Just shows you that the peak oscillator catches the turn at the top of the market, and then you've got the traditional indicator like the stochastic that doesn't catch it. So that's what that's all about. So I'm going to go ahead and, did that question go out? Okay, good. So there's the question for people to answer. Now we're going to talk a little bit about how to measure a statistically significant turn. And the reason this is important, I'm on slide 21. Can everybody see that? I'm on slide 21, simplified volatility true range. And so for those of you who don't know what true range is, it's a very common measurement that is used in the market. The true range looks at the high minus the low, the high minus the previous close, or the previous close minus the low minus the previous close minus the low, and whichever is greater. So it basically looks at market range And I first learned about true range in a book by Wells Wilder that was published in 1978. So I don't know why somebody isn't seeing the chart, but it's up. It's slide 21. So what I want to talk about is the fact that when you have a market trading, the average range isn't always indicative of how the market's behaving. You can get a very wide variability in bar size or very small variability in bar size. And the more variable the bar size is, the more you're going to get chopped around on trades. You can get big reversals when you have a lot of variation in bar size. So true range is a measure of bar size, and the distribution of true range can give you an idea of how much variation you have. And so we have a method called the DevStops, which use the mean, 1, 2, and 3 standard deviation for stops. And I just want to say, for those of you who are interested in entries and a little bit more about our stop system, that was the subject of the first seminar that we gave. So you can contact Dean to get a little bit more information about the first seminar we gave a few months back. This is a picture of what the DevStops look like. Here's your bar activity. And then you've got the average, 1, 2, and 3 standard deviation reversals against the market. And the reason we're discussing this is the whole use of the divergence indicators is to let you know that you're going to have a reversal so you can get out of the market. Okay, I have a couple more slides to go through, and then Dean's going to go through some real-life examples with you. So, how well do indicators predict turns? This is the probability of hitting the different standard deviation reversals using the various indicators. So, for example, if you use the RSI, and this is a test over something like 100,000 data points over 30 or 40 different commodities, just a life of contract on the top 30 traded futures contracts. So, a lot of data. And you can see, for example, that if you use the RSI, you've got an 89% chance of hitting the average 2-bar reversal, 70% chance of a 1 standard deviation move. And if you kind of glance through the chart, they look basically more or less about the same. But the real difference comes in how often they catch turns. So what we're saying is, when they work very well. But how often do they catch turns? So if you get an RSI divergence, then 89% of the time, or call it 70% of the time, you're going to have a 1 standard deviation move. The problem is in the opposite direction, is that they're very, very poor at catching turns. So when they work well, but they don't work a lot. They don't catch a lot of the turns. So when they work well, but a lot of turns get by them. If everybody understands what I'm saying there. So if you use the RSI in combination with the stochastic, yeah, we're going to show our indicators working with NinjaTrader about 2 or 3 slides from now. It's just if everybody can just be patient for a little bit. Anyway, this is just to show you that the math with the case indicators works 80% of the time versus about 50% with the standard indicators. And this is the performance with small turns. And I'm going to go through these slides quickly, and this is the performance with large turns because it seems like everybody's really anxious to see the examples. So I'm going to turn it back over to Dean, and he's going to go through the real-life examples on Ninja with you.
Okay, so we're going to go through an example here. I'm not showing entries. The Kase StatWare indicators, the Kase StatWare package does include an entry system. But what we have on the chart here are three of the core indicators, or excuse me, two of the core indicators. We have the KaseCD, which is this momentum indicator on the bottom of the chart, as well as the DevStops, which is the risk management system. Right, like Ms. Case says here, that was the subject of the last webinar, so if anybody has questions about that, let me know. Here we're assuming that we're already long, and the market's trading up, and we're going with the trend, and we get a divergence. So shown in orange here is a completed divergence, where we had higher highs in price with a lower high in momentum, and we could have exited 80% of our position. Now, generally speaking, whenever we see a divergence on a chart, specifically on a longer bar length, like a daily chart or one of the longer time frames that we're looking at or monitoring, then we exit 80% of the position, and we pull our stops into Dev 1. So down here at the bottom we have Dev 3. That's where we're holding our stops at the beginning of the trade, and then we pull in our stops to Dev 1, so we're taking less risk. Now, the moment that this market makes a new high and nullifies the earlier divergence, showing us that it was a premature indication, we're still 20% long, we still have some of our length on, and we go ahead and widen our stops back out to Dev 3. As the market continues higher, it gives us another indication of divergence. We go ahead and we're already 80% out of the trade. If we had another entry signal in this move up, we would have gotten back in fully long, and we could have exited 80% again. We can go ahead and pull stops into Dev 1, exit 80% of the position, and as soon as the stops are hit, as soon as Dev 1 is hit, then we exit the rest of the position, and then the market continues lower. Now again, this is the reason why we don't look at divergence or momentum indications as an entry. They don't always follow through, but they're a great way of exiting the market and knowing when the market's going to turn and pulling in stop levels. The next slide shows some examples where there aren't any divergences, but we do see peakouts. The peakout globals, peakout locals, basically overbought and oversold signals. In this case, we see the same thing. The market's falling and we get a peakout global. Instead of exiting any of our position, because we treat this as a warning, we'll pull stops into Dev 1. We pull stops into Dev 1 and the market never hits Dev 1 at all. Once the market makes a new low, lower than the peakout global low, then we go ahead and widen our stops back out to Dev 3. So in that case, so to speak, no foul, no harm. We pulled our stop levels in. We took a little less risk. Market never turned. We go ahead and widen our stops back out. The market then falls further and gives us another peakout global signal. Once this peakout global signal forms, we pull our stop levels into Dev 1 again, and the market turns and hits those levels and then continues higher. Now in this case, once we get the peakout global at the top, we pull our stop into Dev 1, market hits Dev 1 right away, and we exit. So I have worked with a lot of traders that in the past have wanted to use momentum divergence or overbought and oversold signals such as these peakouts as an entry signal. And logically, you would think that that would make sense. If it's showing that the market's going to turn, why not get it in the opposite direction? But as we have seen and shown throughout the presentation here, you don't always get those follow-throughs. So our recommendation is, if you do want to look at divergence, one, use it as an exit system, and two, if you do want to look at it as an entry, use it as a first indication, but don't take a trade. Rather, wait for confirmation in some other sort of manner, maybe some kind of moving average crossover or some kind of entry signal after you get that divergence. I have a lot of traders that work with our indicators in that way, and it works very well. They may look at it like a daily chart, wait for a divergence on the daily chart. Once that forms, let's say it's a bearish divergence, then they'll drop down to an intraday chart and they'll time a short entry. It keeps them from being whipsawed, and it's actually a good trade. And with that, I didn't see any questions. That kind of everything was flying by there. So with that, I'm going to go ahead and turn it over to Ms. Case.
Does anybody have any questions on the example trades? Does anybody want to go back and take a look at anything in particular? If not, we'll wrap up. Does anybody have, we have 8 minutes, so just does anybody have any questions about anything before we proceed? I'll go ahead and explain to you this last slide. People have been asking questions about a free trial. Normally we charge for the trial. It's usually $50. But we give a free trial to the webinar registrants.